Welcome to the Explainer. After a pretty long period of smooth sailing for investors, the market has suddenly hit some really turbulent waters. So in this Explainer, we're doing a mid-year checkup. We're going to try to understand what's changed and, more importantly, how to navigate all this volatility.
So let's set the stage. The market came into 2026 on a real high, right? We had 3 straight years of double-digit returns. But all that optimism, well, it stretched expectations pretty thin. It feels a lot less like solid ground and more like a high-wire act. And now the political winds are definitely starting to blow.
And that wind has absolutely started to blow. So it all comes down to this one critical question. How do you protect your portfolio? We're going to break down the geopolitical shock that's really shaking up the markets, and then we'll lay out a clear framework for how to handle this new reality. Okay, first up, the geopolitical shockwave. To really get a handle on the recent volatility, you have to look at the catalyst. And believe me, this isn't just some background noise. This is an event that has fundamentally shaken the entire global system. It all kicked off on February 28th. What had been a long simmering shadow war just erupted into a full-blown, high-intensity conflict, codenamed Operation Epic Fury. And just like that, in a matter of hours, the entire risk profile of the Middle East was rewritten, leading to the shutdown of one of the world's most critical waterways. So what was the market's first reaction? A textbook energy shock. In just 10 days, the price of Brent crude oil spiked by 40%. Now, this wasn't some minor fluctuation. This was a seismic jolt to the global economy, and it immediately raised the scary prospect of higher inflation and slower growth. And here's exactly why that price spike was so severe. The whole conflict is centered on the Strait of Hormuz, which a lot of people call the world's jugular. Squeezing this choke point doesn't just mess with one country. It literally threatens to starve the global economy of its lifeblood. And this slide really puts it in perspective. The disruption goes way beyond just oil. We're talking about a fifth of the world's oil and natural gas, almost 5% of all global trade, and here's the one that might surprise you, a third of the world's helium. Yep, helium, which is absolutely critical for making semiconductors. The ripple effects are just massive. So, with risk being repriced so suddenly, what are investors doing? Well, capital never stands still, does it? It's already on the move. Let's take a look at what people are calling the Great Sector Rotation. The entire mindset has shifted, almost overnight. That growth at any price mantra that totally dominated the last few years, it's been replaced by a search for safety. Now, investors are prioritizing companies that can actually withstand economic shocks, that offer stability, and that can protect portfolios from the inflation this crisis is creating. And the numbers from February show this shift so clearly. I mean, look at the performance of these so-called defensive sectors. Utilities are up over 10%, not just for their usual defensive yield, but also because of the insane power demands from AI. Energy is, well, it's a natural hedge against this exact kind of supply shock. Materials are seeing a big rebound in things like gold and copper, and consumer staples, they offer inflation resistance because, hey, people need these goods no matter what. This is where money is taking shelter from the storm. And what's really interesting here is that this shift isn't just about hiding in defensive stocks. It's also about a potential broadening of the market itself. For years, it's been all about a handful of giant tech stocks. But forecasts for 2026 are now showing that the rest of the S&P 500, the other 493 stocks, are projected to see their earnings grow at double the pace of 2025. It kind of seems like this crisis might have just sped that rotation up. So, all this brings us to Section 3. Strategies for a new reality. Look, understanding the problem is one thing, but knowing how to actually position your portfolio, well, that's what really matters. Okay, the first strategy is a pivot to quality, and that leads us right back to these defensive sectors. As the slide says, these are businesses with really stable revenues. Think defense contractors with long-term government contracts or healthcare companies providing stuff we all need. Their performance just isn't tied as closely to the ups and downs of the economic cycle. Next up, with a major energy shock happening, the risk of inflation sticking around is very, very real. And that makes inflation hedging a super critical part of your portfolio strategy. This means you've got to look at real assets, things you can physically touch, like commodities, that tend to hold or even increase their value when your currency buys less. And of course, the classic inflation hedge, the ultimate safe haven asset, has responded exactly how you'd expect. As tensions just shot through the roof, investors stampeded into gold, pushing its price to a pretty staggering $5,400 an ounce. Gold is just a primary beneficiary in an environment like this because it checks so many boxes, right? It's a store of value that's totally independent of any single government. It often zigs when the stock market zags, which give you crucial diversification. And in a crisis fueled by an oil shock, it's a direct hedge against that exact inflation. It's basically the ultimate portfolio insurance during times like these. Okay, let's pull all of this together into our final section, a simple portfolio health checklist. I want you to think of this as a quick review to see how your portfolio stacks up against this new, much more volatile reality.
First, take an honest look at your diversification. Are you maybe over-concentrated in a few stocks, especially ones that rely on consumer spending? Second, check out your hedges. Do you actually have exposure to real assets like energy or gold? Third, prioritize quality. Are you invested in companies with solid, stable revenues? And finally, review your global risk. How exposed is your portfolio to what's happening in energy importing regions like Asia and Europe? Taking a hard look at your portfolio with those questions in mind is more important now than ever, because the key takeaway from this whole sudden shock is that the landscape has changed. And that leaves all of us with a final, crucial question to think about. In a world like this, is simply buying and holding good enough anymore, or has active risk management just become absolutely essential?